Hello, everyone, and welcome to a live session today. I'm super excited to have everybody here and to talk about how to create delightful investor reporting in today's digital world, which is, of course, a pretty hot topic with everything that's going on in the world right now, with everything sort of shifting digital with COVID. And today we have myself, I'll be moderating the session, Stuart Balcombe, the product at Nth Round, and two fantastic speakers, Graham McConnell, CEO and founder at Nth Round, and the real star of the show, David Gerogosian from Standish Management. He's a director there with a ton of experience in this space. And Graham and David are going to cover a few different topics today, ranging from sort of the state of investor reporting, the different levels, the sort of spectrum of investor reporting which is available today, and how to go about actually implementing investor reporting for yourself. So with that, I'm going to hand it over to Graham and David.
Great. Thanks, Stuart. David, just as way of background, do you want to talk a little bit about Standish and what you do there?
Sure. And so thank you. Morning, no, maybe good morning, good afternoon to many. I'm David Gerogosian. I'm a director at Standish Management. We are a very well-known, now international fund administration consulting group. And we serve all aspects of private equity. We're very well known in the venture space across the country, mezzanine, debt type funds, fund of funds, a lot of concentration in real estate as well. We service our clients from 14 offices across the United States and 2 offices in Europe. And when I say serve our clients, we are a third-party fund administrator. That's typically what everyone knows the third party to be, the TFA. We work closely with GPs, investment teams of the funds, working directly for the fund managers on behalf of the LPs. And so we are at the forefront of all the investor communications, financial statement prep, and the majority of the communications that are going and platforms that are used, et cetera, which is part of what we're here to talk about.
Yeah, great. Thank you. I think one way to kick this off might be to differentiate between fund accounting and fund reporting. And obviously they're highly intertwined, but I was hoping maybe you could talk to us a little bit about and maybe try and tease the two apart, because I think we'd like to focus on fund reporting, but there's the other half of it, which is accounting. Can you talk to us a bit about how Standish does that?
Certainly. As we all know, the fund itself, has raised capital from private investors. Capital calls are made, investments are made, expenses, income run through the fund, and perhaps other sidebar, parallel funds that they're operating on for co-investments. So how is all that tracked? It's all managed through the general ledger. So that's the accounting platform. If you're working, the question is oftentimes asked, who's the keeper of record? Like if you're out fundraising, et cetera. Are you in-house? If so, what accounting platform are you on? Working with a group like Standish, depending on what the needs are, we manage that side. And there's an old term that's used. It's called bookkeep. It's integral to everything that's going on because it's building out of the general ledger, the debits and credits, tracking all the information. And from there, as you're booking those entries, doing the monthly reconciliations, tracking the loan servicing, if it's a mezzanine debt type fund, you're building a rather robust amount of financial information that is housed in that software accounting platform itself. And from that standpoint, I think the next question, maybe to lead Graham a little bit, is once you've got that information and it's tracking on a weekly, monthly, quarterly, annual basis. So the question then comes down to, so that's basically the accounting. Okay. And they're depending on the complexity of the fund, everything that's going on. Equity and venture, it obviously is it's a different animal. We're all familiar with the term, but that's primarily equity investing. So I'll call it rather quiet in terms of what's going on outside of valuation marks, additional investing. When you're working on a mezzanine fund or perhaps a senior credit type fund, the train is moving much faster. The transactions, the velocity increases over time. So as you look at this, the scale kind of goes year 1, year 2, 3, 4, 5, to where if you're running a very robust portfolio. And depending on how you're investing, you may have many outside parties involved. You may have a loan servicing group, either internally or externally, that's managing all of that for covenant default, tracking of interest, switching the toggle between accrued, PIK interest, etc., and reporting back either to your in-house CFO and controller or to us. But we are basically where all that information ultimately resides.
And apart from giving LPs access to the accounting software, which I think would be probably very confusing for them, and I think we'll talk a little bit about drill down and how
Sure.
investors are kind of wanting more information or the ability to have more information. If we take an example of a very vanilla, let's call it a real estate fund. What's the kind of information that standard reporting kind of across the board?
No, it's a good question. The term gap is the first one that pops into everyone's mind. If you go back to the governing documents, you're supposed to provide whatever is in the limited partnership agreement. That's effectively the contract between the GP and the LP. And specified in there by our trustee attorneys basically is the minimum level balance sheet, income statement of cash flows, statement of investments. So at one point, that's what was reported. You get assets, liabilities, which is basically accounting or finance 101, and then a little bit of detail listing name, address, amount of investment, where it was located, what the fair market value mark is on that. And that's what's audited by your auditors at the end of the year. So it's done quarter over quarter. Typically, there are some funds that may only be reporting on a semi-annual type basis, but from there, it's really increased over time. So even though the contract may show that's the information that's required, the investors need to and want to know more. So it's either accomplished through executed side letters, typically by institutional or larger investors, socially conscious investors that need to know more information than what's maintained, let's say, within the trial balance and the general ledger. Because again, we're housing numbers, transactional activity, not all of the other color around the investments themselves. So the question then perhaps goes to, where's that information? How is that housed? It's a collaborative effort when you're working with third-party administrator. That information is tracked typically by your investment team, communicated to us, and we will build out and augment reporting as need be. Think of it, if you're an investor, you'll get financials, you'll get a K1 at the end of the year, but the annual meeting, when you're attending that, you might be getting a deck equivalent to the PPM that you had signed on with, of showing all the granularity, valuations, all the impact that's going on. So you'll have, like, investment by investment, more detail as to what's going on, more disclosure. The GPs understand, they've listened to the LP base, that they need to provide more of this type of information across the board. And as you get into other types of requirements and standards or specs in the reporting, it sort of goes down two categories. So Graham, as I've talked to you before, IOPA, Institutional Limited Partners Association, has standards that they have all adopted. And more investors and GP groups have been adopting this on an international basis, looking for more disclosure. So on the IOPA side, which is more granularity and detail on the fund itself and how it ties into, say, capital allocations. So, 10 line items of information disclosure for my pro rata share of my capital call or my capital balance quarter over quarter. So those are accounting records that are available. When you're looking at the portfolio information, the valuation type data that's being collected, again, that's sort of the division between the accounting platform for the most part in terms of the general ledger versus other components that may be available. But it finally gets to the final question: how is it managed? How is it all reported?
Right. Yeah. Yeah. And if we look back 10 years, then I'm not even sure when ILPA was first put into place, but going from paper statements 10 years ago to where we are today, ILPA is adding a standardization, I would say, to
Yes.
this kind of reporting. Would you say that ILPA is relatively widely used nowadays? I've heard some. I'm wondering if our listeners are hearing ILPA and shaking in their boots, or whether it's something that is pretty standard.
I would say it's not the standard, but at the higher level, the more sophisticated, larger institutional investors have pretty much set this as a standard out there. I think the next step down is coming in from family offices that are seeing this information, say at the fund level, and then I'll call it the individual institutional investors that may or may not have been, that interested in this. It's good to know what that breakdown is. And of course, we have a governing body out there called the SEC that wants to see this level of disclosure, because this is how they can drill down just on produced financial information to look and track to see, are there any significant changes within a fund? In particular, especially later in life when the fund might be winding down, are they pushing expenses to the fund rather than at the management company level?
Mm-hmm.
And as I see clients today, I can't tell you what percentage are doing IOPA type of reporting, but over 10 years, I would say no one was doing IOPA that I work with. I had a practice with about 75 funds back about 10 years ago. It's one of the questions I ask when I'm talking to someone that might become a client of mine now, or as a new fund. And if they are an existing fund that I'm working with, one of the first things I look at is to go in and see what are the disclosure requirements, et cetera, et cetera.
So it may be that the first time that a fund adopts ILPA is when they have an institutional investor come on board, and then
yes,
gotcha. And right. That's something that's determined at the outset. Essentially, when an institutional investor comes in, they basically stipulate that ILPA be in place. Is that?
Yeah, think of it, it's a dance. It's an intro. You do your PPM, you're working up with whoever your law firm, fund formation attorney is, your documents. And so maybe this is more beneficial for everyone, for you too, as well, is that I've done fund one, I've done fund two, I've done well, I've had good top quartile returns, and I've been out of the market for 3 or 4 years. You might have missed something in the middle. It's just like the technology. If your computer is 4 years old, it runs fine. Everyone will snicker. Just wait till you try to do one of these sessions here. You better have a brand new, spec'd out computer. Okay, so I've done great. My investors have been happy with me, talking to them, and they say, yeah, we love you guys. We want to invest. I want to write you a check for $10, $20 million. However, you hear the however. It's like, we have, at this point, now that it's a new fund, we need you to adopt certain reporting requirements. And so many successful people are now, I'm in dialogue with a number of them that are seeing this for the first time. And they're also seeing this on the ESG reporting, because that is becoming more and more prevalent, perhaps even more so, I would say, than ILPA at this point. Mm-hmm. So it's more than just how are you going to report? What are you going to, invest in by, say, technology or the size of the check? I see your returns, but now we have this next level, tracking, monitoring, and how are you going to adopt this?
I'm glad you brought up ESG, because I want to dig into that more with you. But before we do that, I'm thinking about kind of what the trend that has made reporting more desire, or made LPs desire better reporting over the last 10 years. And maybe even what's happened over the last 12, 18 months has accelerated that. But in my mind, I always go back to, if you think about it, if you're invested in public equities and stocks, and your brokerage account, I don't know if there are any brokerages out there that don't have an online portal for their investors to log into and see everything. Right. Is that a good corollary to use?
I think it is. Because think of it from the LP side. When you are, whether they know you or you're been introduced to them, a placement agent is bringing you to the table. They have their due diligence questionnaire. And the due diligence questionnaire is proprietary to each investor and what they built out. But they do talk, they communicate, they see requirements that are out there. And I'll go back more than 10 years. I could actually go back to this past year. 15 years ago, everything was being emailed around. Still had people wanted snail mail. And snail mail is now such an old term that half the people I know don't even know what that means. Okay. So, and everything moved at a slower pace at that time. I had managed capital calls on multiple funds, with a feeder, straight LP and direct investors into that, and used to just manage and mail merge and then send everything out, send up friendly emails and telephone calls over the next couple of days. That's what your back office did, just to make sure everyone got that communication. Imagine that today. Getting an email saying, I need to call $1 million from you. Here's the wiring instructions. Here's my instructions and data I've got on you. You're violating all sorts of data and privacy requirements that are, required by financial institutions, et cetera, et cetera. Plus, how is that information being housed? Where's that at? It's all got to be maintained in a secure portal. And while everyone will say that their portal is secure, I think sometimes the question is, how secure is that? So a lot of people have added a question, because it's happened in the industry. It's have you ever been hacked? You hope to never check that box.
Right.
Okay. That yes, I was, because all of us have been hacked personally at some level, whether it was your Target card, if your pension fund group was probably hacked. If you're on Blue Cross Blue Shield, you were definitely hacked. So many people have seen your information. We've become, as individuals, sort of desensitized to that, but there is a very high bar held for those that manage other people's money.
Right.
And it's critical. So that underscoring all of this is, how do you manage that? So setting up a web portal, being able to manage that, being able to give it in a usable format so that, well, it looks good to your tech guys and the people that laid it out and did the blueprint of it. It's got to be able to work for that investor who might be not in the office anytime soon still. So they want to be able to access this. They want to be able to hit it on the phone or the tablet, the iPad, or if you're on a computer, be able to do that and be able to quickly maneuver through, get to what they need to see, what they want, how to download it. And then again, that's just say around the capital call distribution, tax type information. As far as the ongoing monitoring of the portfolios of funds, I think that the institutional investors are very mindful of their responsibilities today, and they are doing more and more drill down as this space has exploded in terms of assets under management and the checks that have been written. You're going to have an institutional investor that's got hundreds of investments out there across the board. Think of any endowment. Think of something like North Carolina State Pension Fund, Duke University, Michigan, Yale, Harvard. They've all got probably hundreds upon hundreds of outstanding investments, and everyone does it their own certain way. You've got to get some normalcy to that data. You've got to get some sanity to what's going on. And back when it was paper, you were looking at a 6 to 12-month lag as your people put everything into Excel for you.
Mm-hmm.
I didn't really know what was going on. So, the lag on your true understanding, except for that interactive relationship you've got with the GP, where you could talk live and see what's going on. It was abysmal. So these were all things that had to happen out here. And it's still happening today.
Yeah, there's a lot to unpack there. We happen to know a fund manager who was hacked, and that was a horrifying experience, I think, for them. But it's something that we grapple with, because if you lock it down so tight that no one can actually see it, then the technology isn't helping you. So there's a balance that definitely needs to be struck there.
So, as I look at this, what goes on in the background with regards to the financial records, the other ancillary information that's important to around the portfolio, et cetera. As time goes by, literally as the weeks and months go by, I see more and more requirements or ask, or this would be nice to have. So this is an ever evolving space. When I spoke on this topic 2 years ago at a large conference, I had some software vendors up on stage with me. I was up because I've been around for a while. And as I described to you, Graham, a couple of weeks ago, unicorn is described as this, mythical investment, et cetera. Everyone's looking for a unicorn. I still think that the whole comprehensive one-stop does everything, my accounting, my reporting, easy access, the ability to drill down, run reports, charts, and graphs, it's not there. It may be, in prototype somewhere, but it simply isn't there. And if it's there, it's incredibly cost prohibitive for a typical manager to be able to come up with that capital expenditure. So again, as you're building your fund and you're raising, I'll just put a low water mark of $100 million. We all know what the management fee will probably be around that. How much infrastructure can you build beyond your team on that on an annualized out? How much of this is fund related expenses? It's always subject to interpretation in terms of what's going on there. But I don't know anyone that ever wants to build just a one and done fund. That just happens typically because of unfortunate circumstance or economy or whatnot. And so I see GP portals, dashboards are becoming more and more a term that's being used. LPs need dashboards, GPs need dashboards. And so anyone that's in this space, working in this space, you've got you can't rest on your laurels. You can't just have release number one. You've got to be working on release 1.01, 02, 03 to constantly look to bring to market what it is that is going to satisfy the needs of the investors and the GP and make it something that is a good value proposition for all.
Mm-hmm.
A lot of people do look at a third-party administrator as the most viable way to do that because you've either, as the administrator, you've either deployed capital into building your infrastructure, you've partnered with other groups, and you have the ability to scale off of that.
Right.
And put them on your platform. So rather than you go out solo and try to do that and figure out how many different modules of whatever system you're going to try to buy into, and each one costs a significant amount as you go from the general ledger to the CRM to the portal if it's integrated into the loan servicing aspect, the cost does significantly ramp up, which does, and if it's a fund expense, it does affect the returns.
Yeah, I mean, I would say that Standish represents the leading edge in terms of that advanced reporting. I think for smaller funds, they can get away with doing it in-house for the standard reporting requirements. But since you alluded to it earlier, I wanted to bring up ESG, environmental social governance. And I imagine, and I think we've talked about this before, that you see what's at the bleeding edge, which is ESG. So even beyond ILPA, there's this kind of emerging trend where a fund makes a mandate to have a certain level of ESG in their portfolio, and they need to do that, right? Can you talk to us about what those kind of reporting requirements look like?
Okay, I won't talk to the group the way how I talk to you two about it. I like to make analogies, sports, movies, et cetera, tell funny old stories, but just look out the window. There are clouds building on this. Or you can say, you've seen like a wave of ILPA. Look out beyond that. There is a much taller wave that is stacking up in this. And it's coming from all different angles. So ESG, we know what it means, but we don't know what that means yet because it's not quite been defined. I used to start with a poll back 4 or 5 years ago. Raise your hand if you're doing ILPA reporting. Many people would raise their hands. And I would ask them what they were reporting. If you were doing this, keep your hand up. And by the end, I would get down to only 2 or 3 that were completely ILPA compliant. They were sort of a term that we use loosely, ILPA light. Okay. ESG is going to go down the same path to a degree, to where it's being determined right now. Where does this fit in? Is it, how is this affecting the grading out and prospects of new investments? People are looking to determine the best way to create an ESG score. So let's just say you're in the energy space. If you wanted to go out and take over and apply some technology to the oil and gas peripheral industry, I think it's hard to get a very high score on that unless you're showing that you are minimizing environmental damage that's created by potential spills, okay, because it's oil and it's gas, as opposed to clean air initiatives, wind turbine power, solar, and again, I'll be the first to say, I don't know what I'm talking about right now because I've not seen anybody come up with what the score is. So I think all of us talking today is good, we have to continue this dialogue because I think everyone's goal should be the following. You can either set what your ESG mandate is and provide your investors or your prospective investors with what you're going to do, or you can wait until somebody simply drops the template on you.
Right.
And now you are ESG compliant to investor one, investor two. Let's just hope that you don't have 5 disparate types of investors that all have different things, because instead of consistently 20 data points, you may now be trying to track 105, or as I used to say, 1,000 points of light, in 10 investments across the board. And keep in mind, as the GP type, you're being asked questions that do require clarification. I would never hesitate to go back as I'm looking at this from an investor to make sure that they're giving you a clear answer, because they may be reading from a DDQ that's asking a question that they don't really know fully what that question is, because it's been developed by someone else. So I always have to dance around the ESG. I danced around IOPA for 2 or 3 years until I finally saw the full implementation of it across systems and whatnot. So if somebody was to ask me right now, David, I've been told I need to provide an ESG policy and how I am implementing this as a GP, first thing I've got to do is look at their portfolio or look at what their investment mandates are. Are they in the right places? Are they asking the right questions? And for a lot of people, I focus on the social side recently. And so I look at what was your history in investing? Did you invest in government determined criteria like a hub zone, low to moderate income? Are you stepping in to a low income area? Are you helping to revise? Real estate, I think, in a way has, and I'm by no means a real estate expert, but if you are expanding or rebuilding in a low to moderate income area or something that's basically at the poverty line level, the question might be, well, what are you building? You putting in high-end apartment retail? Are you building something that fits the community, that's going to help uplift that community? Or are you going to be able to help provide that foundation for jobs? Companies are going to be willing to come in. From the portfolio manager side, let's say of industry agnostic type GP team that's got a couple $100 million or $50 million, depending on the size of the fund. Again, where are you investing? Where do your employees work? Who runs the company? Is there diversity within your workforce? Is there diversity within the ownership of this?
Mm-hmm.
So to me, that part is the easiest to identify and quantify. As far as putting the grades on it, that's someone used to say that's above my pay grade. I think you can make a compelling argument that this is what we do. I think the bigger disconnect comes from is if someone was to ask a question, your prior fund did this, your return was 20%, 23% IRR. What are you projecting with all of this layered on top? I say there's no change, because you should be sticking to your knitting. You should be doing what you do as
Right.
being an investor. An investor at the GP level in the portfolio, because everyone still does want to make money. Last count I looked. Poll the group here. I think everyone still wants to make money. So you still got to build returns into all these other aspects.
Right. Luckily, there are some encouraging numbers. I know, like, for example, companies that have women on their boards actually, I think, tend to perform better anyway. So where there's overlap between ESG and returns, I think there's a huge opportunity there.
Right. And I think that there is a huge opportunity for the emerging manager space. Now, they may not get the large institutional investors in that first fund, but they are leaner, they are meaner in terms of how they want to drive themselves and what they're looking for. I personally work with a lot of minority-owned firms and women-owned firms. And the passion that I see, I'm not going to say it's greater than anyone else's, but they know that they face struggles that some of us cannot really quite understand. And they're looking at at things, I think, a little bit different. Some smaller funds, they are writing smaller checks. They're a little more agile. They can influence and impact areas that some of the larger fund managers, by requirement, they simply have to write such a big check. A lot of deals are being missed by them because it's not getting through the due diligence process. But I think even that's going to change a little bit as the ESG mandate comes down and people are taking a step back. You don't want to manage 300 portfolio companies. You're not a bank or you're a private equity firm. But I think that it's going to, longer term, it's going to open up great opportunities for very small companies, more so than we've seen in a long time.
I think the industry tends to be a little bit reactionary. And I think the funds and the investment companies that are at the leading edge are actually they're going to win in the end. And the way to do that, selfishly, is to, I think, use software, but also have the right help, which is where firms like Standish come in. I'm conscious of the fact that we have only 5 or 10 minutes more. Stuart, have we had questions come in that we want to pose to David?
Yeah, I mean, I certainly have a couple that we can dive into, again, conscious of time. But I'm curious, from all the talk of ESG and the difference between ESG and IOPA, what do you think realistically for a sort of timeline from where we are today to for ESG being sort of standardized reporting? Are we looking at months, years? When, and obviously this is sort of all a little unknown, but at what point do you think that this becomes standard practice? Like, how much of an advantage are firms getting or funds getting by being sort of ahead of the curve here?
I think, good question. If that came from the audience, great. If that came from here, Stuart. I think that there are certain sectors, it's live right now. Certainly like in the energy space, I'll use that as the best example. It's there. I think that in certain asset classes and size, it's there. I mentioned the emerging manager funds. I think it's a great selling point. It's a way to get the attention potentially of some larger investors that are looking to start deploying capital in that format. I think that there's been a lot of social investing. There's been governance in play, for quite a while in terms of disclosure, drill down, and additional follow-up information, data points, etc. The environmental side, again, which I think is got to be the hottest topic for a lot of people. I think it sort of ties in. It's a race between E and S. And G, quite honestly, has always been there. We've always been audited. SEC is now examining people, etc., etc. As far as trying to come up with the equivalent of this is GAAP standard, or this is the IOPA adopted methodology. I think that anything along these lines, it's going to be an ongoing morphing. It's an evolutionary process. I'll give it 2 years where I think everyone is going to be pretty well standardized. What I mean by that, it'll be the questions from the LPs. It's going to be the presentations going out to the for the prospective investors. That's all going to be pretty well slick wrapped and speaking to all the pain points, all the hot topics. But it's going to always change. It's going to always be moving forward. So software developers, make sure that you can be fluent and expansive. And the investors themselves, what I would like to see is, quite honestly, because of my regulatory background back many years ago, I'd like to know where the SEC is going to go with this, if anywhere. Now, as you two know, I've got a lot of experience with what's called the SBIC program, multi-billion-dollar government partnership with private equity funds. They've been doing basically ESG reporting for 25 years. Just didn't have a name for it because they track taxes paid. They track employee growth. They track minority ownership, gender diversity within portfolio companies. It's not a requirement to get money or to get licensed, but they're paying attention to it. And those types of funds that are interested in being raised today, they get the attention from the SBA that has a $4 billion, we'll call it budget or endowment year over year for investing in funds. And they're going to be expanding their program. They're going more into micro type funds. But again, underlying all this is that it's not a requirement. I'm not seeing examinations on those types of funds. We are seeing still more SEC catching up on disclosure at this point. But I am worried somewhat that one day the GP's goal is to deploy 50% into renewable energy, and the SEC just happens to come in for one reason, doing their normal audit, and they ask the question, well, where are you with this? That's the LPs and the GPs in my mind. And I shouldn't say anything else about the SEC. I know a lot of people there. They're great people.
Yeah.
And I've been on some presentations with them recently, and there's just a lot going on for them. So does that answer your question in a roundabout way, Stuart?
That was a great answer. And we also have a related question here, which may have already answered in part, but is that, is there already a recognized organization, whether it's with IOPA and sort of, I guess, specifically with ESG, that will do the scoring or do the sort of quantifying of the criteria, similar to this question came in from the audience with an example from architecture with LEEDs, with companies being sort of held to a third-party standard for compliance?
Oh, well, let's see. If I just click back on my other screen over here, I think I get 4 pages of ads, as they call them, but websites where consultants, good people, have basically taken this. It's no different than SEC compliance. There are SEC compliance groups throughout the country that will work with you in lieu of the CFO to help build everything that's required for SEC compliance. ESG, same thing. And I'm not here to give recommendations to anyone particular in that space, but if you look for them, you can find them. So the key thing is, of course, finding the one that works potentially best for you. And keep in mind, as you're going through stuff like this, that if it's your first time diving into it, I think the best place to go is either to your prior investors, your former partners, or people you've done co-investing with that might be a step ahead of you. If they're in fundraising or they just closed the fund, it's best to find out from the people that have just walked up that hill.
I'm looking at the time, and I think we are running up against it. If there are other questions, we will follow up, and in some cases maybe even connect you with David, because David, you're an absolute expert in the space, and we really appreciate you joining us for this. I know that our listeners do as well. But with that, we'll have this posted online if everyone wants to go back and check it out. But thank you again, David. Thank you, Stuart, for moderating. I think we'll leave it here.
I want to thank everyone for making some time today. And if we do this again in 3 months, the answers might be different, guys.
Yeah.
Because everything is evolving quickly around here. So look forward to hearing from anyone that's got a question or a follow-up, either about Standish, and by the way, the disclosure I forgot to give at the beginning is that any opinions are those of David Gerogosian solely, not the opinions of Standish management. Okay, but everyone have a good day, and Graham, Stuart, keep fighting the good fight, and I look forward to talking to you both soon.
Sounds great.
You as well. Thank you so much.
Thank you. Take care.